Recording going. Okay, I'd like to welcome everyone today to cash flow management. This is a very important topic for businesses, and we would like to thank the East Cambridge Savings Bank for sponsoring this presentation along with the series of financial issues for businesses. I will put into the chat the next in the series so that you can attend if you haven't been following along as we went. But I believe, Debbie, you're going to go ahead and do a little East Cambridge Savings Bank intro first.
Robert's going to do the introduction today.
Oh, okay, great. Yeah, if you wouldn't mind, that would be great.
That'd be great. Hello, everyone. SCORE has been a great partner to work with, and we continue and are willing to provide these outstanding workshops. East Cambridge Savings Bank is a mutual savings bank. We are not a publicly traded company, and we do not have investors. Mutual savings banks have been around since the early 19th century and are still common in New England. Our bank was founded in 1854 and has been operating with the same name and charter since then. We've never been acquired or sold to a larger bank. Now, since East Cambridge Savings Bank is a mutual bank and does not have shareholders, we reinvest profits locally through mortgages, loans for small businesses, and supporting nonprofit organizations. Thank you.
Great, thank you, Robert. And if anyone has any questions for the bank that they think of later, could you put your contact information into the chat for them to have that, if you don't mind? And I'm going to go ahead and turn it over to Jim. He's from the SCORE Cape Cod chapter, and he's going to talk a little bit about SCORE.
Great. Thanks, Teresa. And good afternoon, everybody. Welcome to today's webinar on cash flow management for small businesses. This program is being presented on behalf of all of the chapters in the Massachusetts, Rhode Island district of SCORE. I'm Jim Danhauser. I'm a volunteer mentor with the SCORE chapter on Cape Cod and the islands. And I'm going to be leading today's discussion along with my colleague and friend, Gloria Spence, from the Boston chapter of SCORE. For those of you who are not already familiar with SCORE, we're a fully volunteer nonprofit organization and a resource arm of the U.S. Small Business Administration. Our mission is to foster vibrant small business communities through mentoring and education. We've been pursuing this work since our founding in 1964 through educational opportunities like this webinar and by providing mentoring assistance to people who are in business or who are thinking about starting a business. Each chapter in our district has a significant number of mentors and subject matter experts with a broad array of business experience and expertise, all of whom are ready to provide mentoring assistance to you in connection with your business activities. We're also able to connect you with volunteers across the country so that we should be able to meet the needs of virtually every client. Importantly, all of that mentoring assistance is completely free and absolutely confidential. So we'd encourage you to take advantage of that opportunity. If you already have a mentor, it's always a good idea to reach out for an update, discuss current events in your business and what the prospects are and what issues you may be dealing with. If you don't, well, we'd encourage you to try. How do you do that? Well, you can go to the websites listed here for the appropriate chapter covering your geographic area and click on the Find a Mentor tab to get started. If you'd like, you could also enter your name, your geographic location, and your email address in the chat, and we'll take care of getting the process rolling for you. Just quickly, a couple of rules for today. We ask that you use the Q&A feature on Zoom, which you should see at the bottom of your screen, to ask questions. Gloria and I will try, as we go through the discussion, to pose the questions that are raised for each other. And it is easier for us to do that by keeping track of just one function. So use the Q&A to ask questions. Don't use the chat except if you have specific comments that you'd like to make. And we'll be sending out by email approved recordings and slides in the next couple of days. As I mentioned, I'm a volunteer mentor with SCORE. I've had a long career in businesses, both in attorney and in finance. I've served as an advisor to a large private equity company and an advisor to a number of small businesses. And I continue to do that through my efforts with SCORE. Gloria has also a long business career in finance. You see listed there her experience with Hearst Television. She is going to start off the conversation this morning or this afternoon. So Gloria, I turn it over to you.
Right. Thank you, everyone. I was with SCORE for about 5 years. Now I do a number of financial workshops. This cash flow, QuickBooks, financial reporting, pricing, a number of others. So that's primarily what I am doing now with SCORE. And so today we're going to be covering a couple things. Some background on a brief overview of financial statements, which cash flow is one of them. Talk a little bit about startup costs and budgeting. That is a topic that warrants its own webinar. So we'll only be touching briefly upon it as it relates to cash flow. And then we're also at the end going to kind of tie all these numbers together and how you actually use it to manage your business. So objective, goal. The objective of any financial reporting system is to gather the information and to gather it, input it accurately, completely, and also timely so that you can make better, smarter decisions about your business and be proactive and not reactive to these things. And the key to the financial reports is the accuracy and completeness of them. So there are 3 basic financial statements, and I always add, which I didn't put here, I always add the 4th one to be an annual budget. The annual budget could be used as the cash flow is one and the same in the beginning for small businesses. But the income statement, also known as the profit and loss statement or P&L, people use these names interchangeably. It's the exact same report, just different names to confuse everybody a little bit. And what this does is it shows the results of a business for a period of time. It shows the income, the expenses, and then also your profit and or loss. A balance sheet is a snapshot of the financial position of the business, also as a specific date. It's accumulative. It represents what the business owns and owes. That's a little typo at the back there. Owns and owes. So it would be your assets, what you own, and your liabilities of what you owe pay out. Both of these statements, these reports, are generated by your accounting software. It's just gathering the information that you input into the system. The cash flow statement, on the other hand, is not. It is something that you have to create from your business experience and your historical information if you have any. So it makes this report a little bit hard to put together, a little bit challenging, because not only you have to predict. Now, a cash flow statement tells you I have to predict what is going to happen in my business, usually 12 months out. So for startups, and again, this is just real quickly, all startups need to prepare a cash flow budget showing what your costs are of developing and planning and getting ready to operate. You need to know how much money you're going to need to have up front before you start bringing in any income. So you've got to keep track of these. You also have to include expenses expected in the initial period of about, we usually say 16, 18 months, to assure that your business can continue even when you don't have the revenue to cover it. Most businesses don't have enough revenue in the early stages of the business. So you have to plan for that. You have to make sure that you have enough cash in advance of these things happening. And you should always include a contingency, because there's always something that you missed. I mean, or you changed your mind on. So you want to have some extra cushion there. But again, other webinars will follow, will focus on these startups exclusively. But the cash flow report is something that should stay with a business in the very beginning, all through its years. So what's a cash flow statement? Cash flow shows the movement of your cash in and out of your business. Theoretically, it reflects your bank statement. It just puts it in a nice order so that you can make sense out of it all and get some information from it. You look at your bank statement, all you see is totals, ins and outs, and a lot of transactions. But a cash flow statement in any of the financial reports takes all these transactions and put them in a meaningful format so you can again make decisions. We have a template and a couple other attachments here, or websites, I'm sorry, for you to refer to. A lot of these templates are on the SCORE website. So what we're going to talk about is how to prepare a cash flow statement, and we'll go through that. And what this is going to tell you is how much cash do I need? How much cash do I want? And that is important because this is your salary. This is your pay. And if you don't include that in there, you're going to be short in your expectations. You're not going to be able to pay yourself. So at the end of the day, you've got your expenses, and then in a little number in the report, you've got to decide how much you want to take from the business. And then, of course, there's the reality. You have to take what you have in mind. You have to keep that in mind. Am I overestimating my projections of revenue? Do I think this business is going to be, a blockbuster? Well, yeah, but you need to be conservative and really keep in mind, what you can accomplish. And this cash flow report is really helps you, guides you how to manage your business going forward. So here's a very brief template of what it looks like. So we start off with a cash balance, and this report is by month. It serves no purpose if you do it lump sums. How much cash you're getting in and how much cash is going out. And then the net at the bottom, 13,000, 1,000, and a negative 3,000 tells you how much money you're going to have at the end of the month. So, and again, this mirrors your bank statement. Now, I am going to.
You want to go to your Excel sheet?
Yep, I'm going to
Okay, I'm
call
going
it
to stop sharing, so you'll
thank
have to
you.
share it.
Oops, I didn't want that. Okay. So this is what I got to find my little pointer here. Give me 1 second. Where's Teresa? I can't find it. Oh, EndNote, I found it. And Spotlight. Aha, okay. So we're only going to look at two of these tabs. Go away. Why won't that go away? Can you see that other thing there?
We can see it. If you could enlarge it, that would be better, but
Well, I've got something else that's popping up on my screen that I don't want to see. You don't see that?
we just see the sample company cash flow statement and
There we
income
go.
statement,
Okay,
January to December
thanks.
2020.
Okay, so the first tab here, and this is why I mentioned in the beginning, a report of a budget. This is what your budget should look like. So theoretically, you plan your budget in the previous calendar year at the end. And what this does here is that it will show what you are planning, expecting, hoping, what your goals are to happen in the next year. So from the top to bottom, you start out with your beginning balance of the beginning January 1, and in here we've got 51,000. We say our income is going to be this much each month. These are our very modified expenses. Usually the expenses are a lot more detailed here, but I don't want to get too much in here. So what you want to focus on here is the total expenses. So for each month, our expenses in the beginning, first couple months are going to be averaging 9 or 10,000. And then down here, don't ignore these two lines here for right now. They're not important. But if you are to use this form going forward, they would be important. But here's the key one here, and this is your owner draw personal expense, assuming that you are a sole proprietor or an LLC, because you are not getting a paycheck from the business. You are only going to take out money every month or whenever. And so I'm saying I want to get paid $60,000. I need $55,000 a month. This is what I need. And this is your cash flow projections for every month for the coming up calendar year. What this says is I started out with $51,000 in cash in January, and now I've added $57,000 to my cash balance with a total of $108,000. Any questions so far?
I'm answering a few in the chat, but keep going.
Okay. So this is what it should start out to look like. Okay. And, again, these are not numbers that are being generated from your system. If you have been in business historically for more than a year, now you're going to have some history to base your ups and downs on. You have something to compare it to. When you're first starting out, I hate to say this, but it's a little bit of a crapshoot, okay? Although you should do as much research as you can to find out what your numbers are. Now, I'm going to jump to May of the current year. So to maintain this report each month, at the end of the month, you've got to update these numbers with actuals. So these numbers here are in a shaded gray area. They indicate that they are now actuals. So, of course, my balance still was the same. And the income for the first 2 months was on budget. And I used 2020 as an example because if you were using a cash flow and you were in business at the beginning of 2020, a lot of businesses' plans fell by the wayside because of COVID. So what happened is beginning in March, the revenue started to decline. And then we really took a dive here in April and in March. So what did that do to the bottom line? We kept our expenses the same. So instead of our bottom line going up, our bottom line staying here, we're already starting to lose ground. We lost 3,000 in March. We went from expected of 52,000 down to 39,000. We went from 71 to 25. So you could see my plan versus what actually happened. So I've got to readjust. And the sooner you know this, the better you can react to it. And because look at your future, you're at a loss. And also here, in order to make this happen, one of my choices was to cut my salary. I took out $5,000 in these 3 months here so that I could keep my payroll, keep my business running. Is that the best choice? Is that the right choice? It's not the only choice. But if you don't know this, what do you're going to be, panicking. Now, obviously, the biggest line in this business is the payroll. So how long do you keep the staff going? One of the other things too that I wanted to mention in my budget actually I planned to add more people because I wanted to be in a position to grow my business. So my salary increased, and it actually increased earlier in the year, but I came back already and adjusted it. I didn't hire those new people that I thought I could afford to do. So these are the kinds of decisions that this report will allow you to make, very educated decisions. And again, here's my payroll went up, and I didn't touch it because I've got high expectations that things are going to come back to normal, and I'm going to be able to keep or start to add back on to grow my business. The intention of me increasing my payroll was to grow my business. That all went by the wayside. I had to regroup. So you can see here what this report is telling you. You're going to run out of money. Well, actually, you're probably going to run out of money here if you were to pay yourself. This is really when you were to run out of your money. Because I didn't, you're not going to get a paycheck for these 3 months. Now, you could have laid off people. Okay, you could have, I mean, you could go in here and start tweaking all these lines, but your business is payroll intensive. So nickel and diming it in these other areas is not going to make a material difference to you, although you could do it, but it's, it's a death by 1,000 cuts. So this is the value of this report. So any questions?
Well, somebody asked if QuickBooks can generate this report, and my response was that QuickBooks is backward looking. It doesn't really do forecasting for you. You've got to do this with a separate spreadsheet of your own, and it also enables you then to go in and make the prospective changes that you can't make just with your backward looking accounting system.
QuickBooks has recently added a cash flow report, but it doesn't take the burden off of you to make the decisions for the future. It will give you the actuals. It will give you the ability, I think, to do this. But QuickBooks does not tell you what to change your revenue to. It does not tell you which expenses to do. You still have to do the hard work here. All right, no questions?
Okay, so you could stop sharing.
I cannot see with my glasses on or with my glasses off, so I can't find it. Oh, did Teresa do it? There, you good?
Good as we're going to be. Gloria, somebody asked if you covered the detail tab on that Excel sheet. And we made the decision not to go into terrible detail because, that's really not the purpose of this exercise. The purpose of that sheet is to show you the need to stay on top of your cash flow forecast to make changes as things develop in your business. And yes, we will be sharing the templates with you subsequently.
Yeah, I mean, your budget should be as detailed as you want it to be and as you need it to be to manage your business. So I always recommend to put in as much detail as you can. So yeah, but we didn't want to show it because it gets overwhelming for people. It makes the whole report smaller and then you can't see anything.
Okay, then I'll start. You've heard the expression more times than you like that cash is king. There's a reason that people say that all the time. It's true. If you look at history, most failures for small businesses can usually be traced to cash flow problems. If a business runs out of cash, a small business, it has very few options, and that can typically be the death knell. I used to tell people that worked for me and with me that we could survive anything and live to fight another day, so long as we didn't run out of cash. So you have to stay on top of your cash resources, and you'll be sick of hearing me say that. And I hope you continue to feel that you have to do it. Just stay on top of your current and future cash needs to avoid a liquidity crunch. There are some simple things that you can do that can help you. First off, we strongly recommend that if you haven't already, you set up and keep a separate bank account for your business. Run all of the receipts and expenses of your business through that business account and none of your personal expenses. I know that seems very elementary, and it is, but I've had a number of clients who have not done it over the years. And it gets very difficult to take a true state of what your business performance is and what your business liquidity is if you don't separate out the personal and the business expense. And the easiest way to do that is with a separate bank account. It's the easiest way to monitor your cash as to what your actual cash in the bank then is. And it facilitates eventual tax return preparation. We'd also suggest, if you can, that you have a separate credit card for your business. Again, use that only for business expenses and not for personal. Now, people sometimes ask me, why can't we just have a debit card? And you can. But a debit card only allows you to make purchases on it to the extent of the balance in your bank account. A credit card can be used to make purchases which are not supported by your current existing cash, but which will be covered by subsequent cash inflows. And it also enables you to begin to establish a credit rating for your business, separate and apart from your personal credit rating. Be aware, of course, that credit cards are among the most expensive forms of financing available, and you don't want to be overutilizing them. But having them available can be a very significant help to your business in certain circumstances. And again, it helps you to keep track of your business performance. You should look at your cash flow statement at least monthly. And as Gloria said, you need to keep a cash flow forecast for the next 12 months and keep it updated because circumstances change. Even if we don't get the onset of a pandemic, business conditions can change. New competitors could open up. You could have significant increase in your operating expenses because of an inflationary period. So you need to take account of all of those kinds of changes and be sure to stay on top of your liquidity needs. Now, I know that you did not get in business to be an accountant. You did not get in business to be a banker. But in my view, there are two primary responsibilities of a small business owner. One is sales, and the other is cash flow management. And if you don't pay attention to cash flow management, you will live to regret it. You should maintain good accounts receivable collections if you're in a business that generates accounts receivable, and we'll talk some about that as we go forward. And you should avoid overdoing it on the purchase of supplies, inventories, and equipment. I know retail businesses all want to have a full line of inventory available, but just recognize that purchases like this eat up cash, and you need to make sure that you're doing it intelligently in the context of the liquidity that your business is generating. We've talked about generating a cash flow forecast for each year as part of your annual budgeting process, and make sure that you update that at least monthly or more frequently if you have to reflect what actually happened and what you expect to happen over the next 12 months. And if you begin to see things getting tight, you have to look carefully actually at what you need to spend over the next week and the next month to make sure that you deal with issues when you have the capacity to do that. Things change, and you need to reflect the impact of those changes on your business forecast. You simply can't make smart business decisions. And these are many. Should I add staff? Should I buy equipment? Should I take on work? Do I need to reduce expenses? Unless you can see what your cash situation is going to be over the next 12 months. And I'm here on the Cayman Islands, so I always tell people they have to remember how important seasonality is in your business forecast. I know businesses feel great in June, July, and August when things are really running and gunning. But in my experience, at least so far, every year also has a January, February, and March when things are much slower. So you need to keep that seasonality in mind when you're generating your cash flow forecast. Now, I see there's some questions that have come in. Gloria, do we want to take those now?
It looks like she's typing in the answer.
Yeah, I'm answering it by chat.
Okay, that's great. I just wanted to go back to this very brief cash flow forecast for just a minute to highlight the importance of your cash flow forecast in making your decisions. This is a business that started the year with $20,000 in cash, It brought in $335,000. It spent $349,000. So it had net cash flow of a negative 14. So it ended up with a $6,000 cash balance. I recognize it's only 6 months, not 12 months, which I've been preaching you should have, but it's just much more easy to see it this way. So everything seems, it's a little tight, but it's okay. Well, not really, because look at where this business got to. It got to a negative $3,000 balance at the end of March. That's not fatal. These are small numbers, but if you put a few zeros on it, you could see how important it could be. How did they get there? Well, in anticipation of building for this season, they made a significant inventory purchase in February of $20,000. If they knew they were going to be in the hole at the end of March, they might have considered whether that inventory purchase at that level was necessary, whether they could buy some of it on credit as opposed to buying it for cash. They bought a piece of equipment in March that cost $12,000. Again, very small numbers, but just take them as an example. Well, if they knew when they made that decision that there were going to be negative cash at the end of the month, they might have had a different approach to the timing of that purchase, or they might have sought to buy it on credit, because one of the most ready sources of credit available to small businesses tends to be in the equipment financing area. And so that is an option that could have been considered to avoid that kind of short-term liquidity crunch, which can be very difficult to deal with. I want to talk a few minutes about accounts receivable. Now, you may be in or thinking about being in a business which doesn't generate accounts. It may simply be a retail business where you get paid in cash or by credit card for every sale that you make. But a lot of services businesses generate accounts receivable. And I can tell you from the numbers of clients that I have mentored that this is a major issue for small businesses. It causes as many liquidity problems as almost anything else, and is oftentimes just a pain in the neck for the people who run the business to have to pay attention to. So what do? Well, develop and maintain good accounting practices for accounts receivable. Those include timely billing. Get the bills out as soon as the work is done. Now, you don't have to do that. That doesn't necessarily mean if you finish the work on Monday, you send the bill out. Maybe you develop a practice of sending your bills out once a week. But whatever that practice is, stick to it, because people will not pay you if they don't get their bills. Clearly state the work that's been done, what's owed, and when payment is due. And there are very simple invoicing tools that are now available that make this very easy for you. Most accounting systems have an invoicing tool, and it's useful to do it within your accounting system if you have one, because it allows you to more readily track payments efficiently within the system itself, and it integrates the sales and the cash receipts into your accounting system. We recommend that you send bills out not just by email, because people can claim that it went into their spam or promotions folders, but send them by regular mail as well. Make clear how checks should be made out and where they should be sent. And if you are prepared to take it, add instructions for online paying or for credit card or debit card payments if applicable. And if you have larger customers, get to know who within that business is actually making the payments and communicate with them regularly. And then you have to, either you or somebody you trust within your business has to monitor the collection process. Make sure that you find out when payments are late and get in touch with customers once payment date has passed. You don't need to be overbearing, but you need to make sure that you are on the to-do list of the customer who hasn't paid you. And if you have continued problems with customers, well, then you need to think about whether you want to continue to do business with them if they're simply not paying you. It is, after all, your money. If you have a serious delinquency, you can think about sending a formal letter. But if you choose to do that, don't threaten. Just add language saying it's an attempt to collect a debt. You can also think about legal action for longer delinquencies, including small claims court. I have a client on the Cape who insists on going to small claims court whenever a payment has been long overdue, because they want to develop a reputation as somebody who needs to be paid. Not everybody likes to do that. There is expense involved as well, because you have your time, even if you don't use an attorney. And so I would counsel, before you do that, check on the ability of your debtor to pay. Because many times people aren't paying you just because they can't. So be prepared to cut the price and collect what you can before you proceed. What else can you do? Well, you could consider early payment and prepayment discounts for customers. And we've had a lot of discussion about this over the years. We're not suggesting that you would give somebody a 50% discount if they pay early. But a 5 to 10% discount can be meaningful in terms of getting away from having accounts receivable problems. For example, I have an in-ground irrigation system at my property. Each year, the company that maintains that for me gives me an option of paying it by the end of March for a 5% discount. I do that because then I don't have to worry about getting the bill on a monthly basis and making the payment. They do it because it gets out of having any accounts receivable issues. And it also happens to get them some cash at what is a slower income period for them for their business. You should also consider getting credit card authorization or actually accepting credit cards. Many people who provide services now, contractors, for example, will, with a very simple Square device, when they have done the service, they will get payment on the spot by credit card. They don't have to collect the credit card information, but they can get credit payment right away. Yes, they will pay a fee for the use of that, but they know that it is much easier for them than worrying about having to chase people down for payments.
Jim,
If
I
you
have a
actually get,
question.
go ahead.
Somebody asked, why is the language that this quote, this is an attempt to pay, important?
Because you don't want to get into a situation where somebody claims that you are threatening them or coercing them for payment. That's why lawyers will advise you to just put in the language, this is just an attempt to collect the debt. If you do get credit card information from your customers and you're going to use that once an invoice is approved to charge against the card, just be sure you safeguard that information if you in fact get it. And if you're a builder or a other contractor, if you're going into big projects, make sure you establish upfront a payment schedule that works for you. And if you have large job-specific supply purchases, you should get the client to pay cash at the time of the purchase for the cost of the supplies. Other working capital tips, and working capital is a term of art. It simply means what is your current assets, your cash, your accounts receivable, and your inventories, compared to your current liabilities, the debts that have to be paid in a short order of time. So you should avoid overbuying supplies, equipment, etc. When you're making purchasing decisions, do it with the impact on your cash flow forecast in mind. And we would advise that you don't pay your accounts payable early. Just pay them on time. I know everybody wants to be a good customer because it's not easy to have suppliers for small businesses. But if people are giving you 30 days to make a payment, don't pay it on the second day. Pay it when it's due. It's also important that you do not use employee tax withholdings or sales and meals tax withholdings or receipts as your cash. I have seen clients get in trouble doing that. They reach a short-term cash problem. They dip into those collections, anticipating they'll be able to return that money before it gets into a problem. Well, it's not your cash. There can be criminal liabilities associated with it. So when you have tax withholdings, you have sales taxes or meals taxes, pay them over to the proper authorities on a timely basis and don't use them as your cash. Financing, because there will be times in your business where you will need to have financing available to you. Well, people talk about sources of funds, including family and friends. That's a euphemism that refers to people not just in your immediate nuclear family, but in your circle of people that you know. What else can you use to finance your business? Well, personal savings and assets, including retirement accounts. But be careful. It's a question of your personal risk tolerance. How much are you prepared to run the risk of losing in the context of a business activity? As I mentioned, you can use credit cards from your business. They do have a high cost, so you should be conscious of the cost associated with those before running up significant outstanding balances. Bank loans certainly are available. They can be more challenging for small businesses to obtain, particularly from the bigger, what we call money center banks. So if you are thinking about pursuing a bank financing, you'd be much better served to think about credit unions, community banks, and the like, who are much more accustomed to dealing with small businesses. Typically, bank loans will always look at your personal credit score, your personal credit rating, and will also want to get a personal guarantee, which we'll talk about a little bit. You consider financing from the Small Business Administration. They have some programs through which they provide support to bank lenders who are making loans to you. They also have some direct lending programs, and you can go on the SBA website and look to the lender match feature to see if there are some lenders that might be interested in providing financing to you. Equipment financing is often a form of financing that is available to small businesses. And there's lots of talk about online lenders, and there are many of them. And I can provide you names of several. They are generally flexible in terms of how rapidly they can make decisions, but they are also expensive. People look at it sometimes and say, I can borrow from an online lender at 9 or 10% interest rate, but that's not the true cost, because there will be origination fees that will be associated with those loans. They may be shorter term, so the actual cost of that loan is going to be significantly more than the stated interest rate. So you just be mindful about that when you pursue it. And people talk about crowdfunding, but that really is much more for special circumstances. It requires significant effort and time. So unless you have a really compelling story to tell, crowdfunding is going to be a very difficult way for you to access financing. So you go to a lender, what are they looking at? Well, they look at collateral. They want to know they can make sure that they're going to get repaid. They may want to take a mortgage on your business or your personal assets, and they will almost always want to get a personal guarantee. That is not because they expect to sue you necessarily if the business is unable to satisfy the loan obligation, though they can. It is to make sure that you are confident enough in your business prospects to actually provide a personal guarantee. I can tell you that the first time I had to do that, it made me sit back and think. But I did it because I had a significant enough confidence in the business success to be providing that, and to understand that absent that, I was not going to be able to access the financing. Banks will also look at your character. That doesn't mean necessarily your moral character, although it can. They're really looking for your experience, your business plan, and your management and business skills. They want to be confident that you understand your business and that you have the real capacity to make it a success. They'll look at external conditions and capacity, and they'll also look at the capital by way of equity in the business. But banks, particularly community banks and smaller lenders, exist to work with you. So don't be afraid of going and talking to banks, but make sure, and you may want to do this working with a SCORE mentor, that you are fully prepared with the material that you'll need so that you can have the best chance to being successful in pursuing that financing. I would also tell you that it's important to establish a banking relationship early on. Even if you're not getting a loan, you're going to have a bank account for your business. You should go in and talk to the bank when you're getting that bank account set up. And make sure the bank understands your business, because it's a lot easier if you've done business with a financial institution to then subsequently, if you have a need or desire for credit, to actually go in to talk about that, as opposed to going in cold and saying for the first conversation, I need to get financing. So important use of your time to establish a banking relationship. You should try to establish merchant credit for supplies and think about working capital financing. Why? Because if you put in place what's called a line of credit that you can draw on as you need cash in your business, that is one of the ways that you can bridge a shortfall to what your business expectation is. You'll pay a fee to have that working capital line in place, but it can be a very useful tool to you to deal with liquidity issues. And make sure that you continue to work on establishing a good track record for your future business needs. So that's that.
Jim, I have two questions.
Sure.
The first one is why do you recommend not paying before the due date, paying early?
It's cash management. So long as you are paying somebody within the time frame that they give you to make payment, they're going to be satisfied. They've given you that time period. So long as the cash is in your business, you can continue to utilize it in your business, making sure that you just retain enough to pay them before the end of the period. So for example, if you see things are getting a little bit tight in a given week, well, you'd be very happy that you did not pay that bill 28 days earlier than it needed to be paid. The cash is simply available to you in your business to utilize.
And if we could welcome our bank folk representatives back, I do have a question in the chat that I can pose to them if they're available. Deb and Robert, or Robert. We do have a question that says, for an LLC, is a personal guarantee still used?
Yes.
Okay.
Usually.
Great. Okay.
And there's also another question here that I think you guys could handle. Is it better to open a bank account with a credit union as opposed to a larger bank like Bank of America?
I always think it's better to work with your local community bank. They're going to get to know you, and you're going to be able to have a physical presence with them. And you know, there are times when a larger bank is appropriate, but for a small business, generally your local community bank. I don't have any comment on a credit union versus a savings bank like ours.
And for a consultancy, are merchant credit lines available?
For oh, you mean for a service business?
Yeah.
Yes, sometimes they are. We don't necessarily call them that. We would just call it a working capital line of credit. And many banks, you know, make quite small loans, 10,000, 20,000. You just want to be, as Jim said, and I think Gloria alluded to, you just want to be disciplined about paying the line off.
Great.
Well, yeah, in fact, typically the line will have to be paid off at least once a year and left at a zero balance for some time frame. It will vary depending upon the business.
Yeah. The cleanup period, we refer to it.
Okay, yeah, we definitely encourage anyone to ask any questions they might have at this time. We have a few minutes left. If you don't want to type in your question, you can use the raise hand icon on your toolbar, and I will unmute you so that you can ask your question out loud. That's not a problem either. Okay. So yeah, if you want to get those questions in, so somebody just put in the chat, have considered having a SCORE mentor since C19. So what do you, I think we can have Gloria or Jim address that. Why do we want a mentor?
Oh, I think there's lots of reasons to have a mentor. Sometimes people aren't quite sure what happens in a SCORE mentoring relationship. I've had people ask me, well, am I going to walk in and, be grilled by 3 people sitting around in suits? The answer is no. The mentoring relationship is one, it ends up as conversations. You try to encourage people to think about their business, where it's going, what their issues are, how they could grow, how they can deal with problems that they have. And then, what do people expect? So as I was saying before, if you're in a position where you're trying to put together a presentation for a community bank, well, yes, you could just walk in and chat, which is useful to start. But if you're seeking financing, you're really going to have a better chance for success if you can demonstrate that you've really thought through your business. So a mentor can really help you to plan, to develop your business plan so that you have the best opportunity for success, easy for me to say, in meeting with a financial institution. And the mentor can help you with all kinds of issues associated with your business. It's intended to be the opportunity to reach on a free basis with people who've been in your shoes before, and can help you to understand where you are, what you need to do, how you need to think about what you're doing, and how you can best position yourself to be successful.
Okay. And I did somebody just asked about face-to-face sessions. The number of face-to-face sessions would vary by chapter. I can answer for Boston. We do have some face-to-face. Most of what we have available is still Zoom and phone, but we do have some face-to-face in a few different locations. And I'm not sure what Cape Cod.
It's up to the mentor. We do face-to-face. We also do it by Zoom or by telephone, or other video chat mechanisms. But most mentors are prepared to meet face-to-face with people. It's a great way to start. I know that Zoom can be more efficient because you don't have to drive anywhere, but it's nice to actually have a face-to-face, real world, whatever the latest acronym for real life is, conversation with somebody. You can develop much more of a rapport and an understanding. You lose a lot of body language in Zoom conversations. You lose a lot of I can look in somebody's face and see whether they really understand what the hell I'm talking about or not. You really can't do that on a Zoom context. So yeah, I encourage people to ask any mentor they're dealing with if they're prepared to do face-to-face sessions.
Someone brings up a good point here. They say it took them a long time to find the right counselor. And sometimes that happens. Not all SCORE counselors have the same areas of expertise, and it's just like any professional that you're dealing with. There needs to be a chemistry, personality connection. And if you don't find that, you can ask for a different one. There's, we're used to that. It's part of the process. So if you don't like the first one, you can go to someone else. It's not a big deal.
Yeah, recognize that all of us who are mentors, we're not in it for ourselves. We're in it to try to give back from the basis of our experience and expertise. And there's lots of times where it's just not a good personal fit. And no one takes any umbrage at suggesting that you'd like to go talk to somebody different. That's happens all the time.
I think that covers all the questions that we have posted at this time. And if you are still thinking about that mentor and you're not sure, you can send me an email, and I will make sure I connect you to the right chapter. I'm going to put that into the chat right now. I will, like I said, I know I work for Boston, but I will make sure that you can connect with your local chapter, and you can reach me at outreach@scoreboston.org and just ask me to help you get that taken care of. And I'm happy to do that. Or if there's a particular person you want to meet with, that type of thing, I can help get you connected. Always happy to help there.
Can I just add one thing, Teresa?
Yes, please.
This is Debbie. So Robert and I are happy to take any questions from the audience, after this session, if they ask for our emails or phone contacts. So feel free to use us to brainstorm if you're thinking about whatever bank debt or next steps. But anyway, I just want to say Jim and Gloria gave you guys a lot of really great detail that hopefully you can use to help your business.
Thank you, Deb. That's perfect. I will absolutely share that information if they would love to reach out to you guys. Yeah. And
I'm putting my email address in the chat. So if anybody wants us to reach out to me directly for conversations, I'd be happy to take that on.
Okay, get that in there. Great. Okay, I think that covers it all today. I want to thank you all for joining us. I want to thank the East Cambridge Savings Bank for sponsoring this series. We hope that you join us at the next event, which I did post in the chat earlier. So hopefully you grab that. If not, watch for the newsletter. Thank you, everyone. And we're almost to the weekend. So I hope you guys all have a great weekend. Thank you.
Thank you. You too.
Thank you.
Bye.
Thank you. Bye-bye.
Thanks, Gloria. See you.